Hello there, everyone, and welcome to our latest episode of the Market Misbehavior podcast. My name is Dave Keller. I'm the founder of Market Misbehavior. Happy to be your host here on the show as we enjoy connecting with market practitioners, money managers, analysts, strategists, traders, brokers, authors, educators, anyone that speaks the language of the markets that we feel can help enhance our understanding of what's happening around us as investors. This podcast now over 30 episodes in, it's been a ton of fun connecting with different market practitioners, really, thinking about and asking about and understanding how they're navigating these markets in a fascinating time in market history. I mean, who would have guessed when we launched it in the fall of 2024, we'd in the first 6 months have a fantastic major top to dissect. And I think one of the great benefits, one of the great joys of a show like this is being able to kind of go along this journey with a number of other successful investors that have navigated markets like this before, just to see how they're progressing, how they're navigating through these periods of market instability. And today, I think, is a perfect example of the benefits of discussions like these, because we're able to share a conversation with Doug Ramsey. Doug's the Chief Investment Officer at the Leuthold Group, a fellow Buckeye, so brace yourself if you're not an Ohio State fan. That did come up at the end of the discussion. I couldn't last the whole episode without asking Doug his feelings on Ohio State's national championship at the beginning of this year. So you can fast forward through that part at the end if you want, but listen to the rest of it because there's a lot of really good discussion about the markets. If you're not familiar with the Leuthold Group, Steve Leuthold is a legend in the technical analysis community. He was one of the first, I would put Steve with, like Ned Davis research and Lowry's research. I mean, these are research shops which were early, sort of like mid 1900s, operations. And as they kind of and when they got started, they became widely followed in the institutional community. The Leuthold Group still to this day publishes a monthly report called the Green Book, and that's what everyone would just call it. And it was this awesome print book that we would get sent to us every month, and it was a fantastic repository. Steve Leuthold, when he was alive and well, would write a column in there, and Doug Ramsey and others who he mentored and eventually took over the Leuthold Group's operations would weigh in with market observations, with ideas, with perspective, and it was just a really fun way of experiencing the markets, not just with your own experiences, but with people like Steve Leuthold and others kind of sharing their own lessons learned and how they went through it. So in my conversation with Doug here, which I hope you really enjoy, I mean, it was perfect because we talked just after the S&P had registered a 10% drop, just after the NASDAQ had a 4% loss on that Monday. And a couple days later, I'm able to talk to Doug about how you navigate those sorts of periods. We talked a lot about the market top, the 24 to 25 market top. We really talked about the conditions going into that peak, at the in the fourth quarter of 2024, all the different changes that started to emerge, going into the first quarter of 2025, which really led to the honest assessment that 10% drop makes a ton of sense when you think about all the changes of character that he and I described. We talk about that mentality of buying the dips, which worked so well in 2024, and why right now may not be a great time to think about buying the dips. We talk about buy the dips versus sell the rips, and I think his comments about how this could be different was really instructive. We talked in particular about semiconductors and which again had been one of the stronger groups in 2024. The AI trade being a big theme there. We talked about how that had changed and really dug into the technical configurations of the semiconductor space. Finally, we talked about positioning, and he had some really interesting thoughts toward the end about not just selling positions that are down a bit, but thinking about hedging and some of the ways that the Leuthold Group that they use hedging strategies to minimize downside risk, or at least manage that downside risk, but really keep an eye on long-term reward. And I thought that was a really important message for all of us to hear here in March of 2025. So please enjoy this really thoughtful and enjoyable discussion with Doug Ramsey of the Leuthold Group. So super excited today to sit down with Doug Ramsey. Doug's the Chief Investment Officer at the Leuthold Group, coming from Minneapolis, Minnesota. Doug, good to see you again. It's been a little while since we've chatted. I think it's our first discussion in 2025. How are things your way? Doing okay?
Good. back from the road, and we just chatted about it before flipping on the recording. But in New York City, and I mean, great. Feels like things are back there, which didn't seem like it was going to be likely 3 or 4 years ago. So, no, energized by that, and energized by market action as well.
I was going to say there are times when I struggle to think about what different things someone like you and I could talk about. I don't feel like we're going to have that issue because our cup runneth over with things just happening in the last 24 hours probably. But we'll see where all we can go here. So I mean, Doug, you're at the Leuthold Group, which is just a successful money manager and well-known research operation in the institutional community. That's where you and I were first introduced, and I really enjoyed following your work and Steve's work for sure. Over the years. Talk to us about now as we're getting toward the end of Q1 of 2025. I mean, it's been a very different experience for investors than we were comfortable with in the previous 12 months. When you take a step back now, mid-March, what is your overall mindset? We'll start there. I mean, are you treating? We're now about 10% plus now off of the February high. Are you seeing signs to be encouraged about what you're seeing? Are you seeing more signs to think more defensively? Like, what's your high level kind of perspective of where we're at right now relative to where we've been?
Yeah, very concerned, and it's not just the chart action. I mean, real quickly to sort of put the upswing that we had, and I'm not ready to for sure say it's over, but we went up 72% in 28 months off of that October of 2022 low. Yeah. It's one of only 2 bull markets that began with unemployment below 4%. And it's also among a select group of bull markets that began without a preceding recession. So we didn't have the typical Main Street pain associated with that 25% downturn that we had in 2022, which lasted about 9 months, which is good, right? But on the downside, that likely from its outset limited how long and how strong the upswing would be. So to stall out with a gain of 72%, we've had many bull markets that have had a gain about in that range, let's say from 50 to 80%. And the common factor of ones that are more truncated like that is that they didn't have the preceding, and I'll just say, quote, advantage of being born during a recession. Yeah. So, and I think that backdrop explains why monetary tightening and the inverted yield curve and the leading economic indicators, all of these late cycle economic signs accompanied the entire upswing, so that in many ways it was vulnerable. And here is really where just, the price action analysis helped us in that, the fundamental work in terms of valuation and the monetary work and the index of leading economic indicators, which is really negative throughout the entire upswing. If you solely focused on those, you would have missed the entire upswing. Whereas, I mean, we are ones that certainly respect the message of the market, and above and beyond that, we would argue that the technical work is probably more important relative to the economy than it's ever been. And that's simply because the stock market is larger than it's ever been compared to the economy, or it was just 3 weeks ago when we made a high. That was 205% of GDP. So think about it, Dave. Wow. I mean, less than a 10% correction already gets you more than a 20% loss as a share of GDP. And just our concern is that to the extent that the wealth effect from rising stock prices and also from rising house prices was something that maybe prolonged the expansion from what the standard leading economic and primarily monetary indicators, inverted yield curve, shrinkage of the money supply, so on and so forth, to the extent that there was sort of a plug from the rising wealth effect. Well, you have to look at the other edge of that sword now and say that, well, it could be the final blow that knocks what for a while has been a slowing economic expansion into a recession. And I think it's as the percentage loss goes up, so does that odds of tipping into recession.
Well, tell us a little bit, Doug. I mean, you mentioned, you really outlined just how things have changed so dramatically.
Yeah.
100% agreed. When you look back at 2024 with how strong and how consistent of an advance that it was. I mean,
Yeah.
we had minimal drawdowns, just a couple, maybe three or four in 2024. And I feel like a lot of investors kind of just naturally assumed that was just going to keep going
Yep.
forever. Now, all of a sudden, things have changed. When you look back at sort of late 24, what stands out to you as those signs that, looking back, we should have recognized were clear, like, exhaustion signs? Is it valuations? Is it inverted yield curves? Like,
Yeah.
what are
Well,
those things looking back that you feel like we should be more aware of next time, if that makes sense?
not valuations and not inverted yield curve, because if you'd solely paid attention to those, you were out a long time
You would have
ago,
missed
right?
most of the good stuff, right? Yeah.
And that really supports, like, using, at least as a tool in your quiver, I mean, the dark art that we both practice, because quite
Yeah.
frankly, I mean, you're right. It was a solid upswing last year, and here I'll just sort of introduce what I think is an important distinction. I mean, the S&P 500 cap weighted dominated everything. I mean,
Yeah.
like, another historically large gap between that and just the average stock in the S&P. It was the worst year on a relative basis for the mid cap 400 to the S&P ever. Mid caps usually, they're a chameleon between small and large. Literally, that's not a surprise. But at any rate, the point is, despite the top heavy nature of the market, we still consider a group like the mid caps or the small caps, or the transportation stocks or utilities, or various cyclical indices. We would say that, hey, even if they're underperforming, as long as they're making new highs
Right.
in reasonable proximity to the latest high in the S&P 500, that's the technicians would call that a confirmation. And so that all culminated with, like, the best looking market from a technical perspective in the week of Thanksgiving, right? We were all fat and happy and maybe sleepy from all the turkey and football. We'll talk about that later, hopefully. But at any rate, the market was just broadly, it was in gear despite those divergences. Well, what ensued then from basically the final week of November up until the high of February 19th of this year was that all but one of what we call, like, our 8 bellwethers subsequently peaked out, and that did not confirm that most recent high in the S&P 500. The one that did, and there's always, like, one holdout, every cycle is different, but it was unusual to see the financial stocks making a new high in mid-February alongside the S&P. Usually you'd expect the financials to also take on some water beforehand, and then, technicians like to say, the troops were lagging the generals. In this case, 7 out of the 8 troops were lagging the general. So, I've been saying that, hey, if February 19th turns out to be the final high, the technical picture going into that high from the prior 3 months, it's going to belong in as a textbook example in some future technical classic that, I don't know, maybe you will write. You've already written one, right? But I mean, technicians will be able to look back and say, oh my God, it was obvious. And
Yeah.
of course, that's how the human mind works. You convince yourself you saw it, but it was there. And then, and now you've clearly had confirmation in terms of the downturn here. We'd be less concerned if you hadn't had that 2.5, 3 months of distribution. So it's very troublesome. And then layered on top of that, and to move beyond the charts, it's just the profound importance of the stock market in supporting the economy over these past couple of years.
Yeah. Doug, there's so many good points that you made in there, and the good news for everyone listening: write a book has been on my to-do list, and is
Good.
there now. The bad news is it's been on my to-do list for many years, and
Yeah.
and here we are, and I still don't have a second book written. So at some point, but 100% agreed. I mean, when you talk about the action in sort of October, November versus January, February, from a technical perspective, I mean, almost night and day different.
Yeah.
From a period where the stock's moving higher with stronger breadth, with stronger support, with leading names looking quite strong, to February, where it's like the number of things that did not confirm that
Yep.
February high. I feel like that's a pretty decent list to think
Yep.
about.
Yep.
So fast forward, I mean, I'd love to dig into a number of these points if we could. I mean, fast forward to where we're at now, mid-March. This week we had Monday, I almost said fun day, which is a nice
Yep.
Freudian slip. Monday fun day. The market's down about 4%, the NASDAQ. Today we're again sort of following through here on Thursday, March 13th. Talk to us about what we've observed now in the last couple weeks coming off of that February high. I mean, I think a lot of investors are sort of in the buy the dips mentality because that's worked so
Yep.
well. When you think of what we've seen now, does it feel like another buy the dips sort of move? Does this feel different? And how would you sort of navigate this crucial period, I think, forward looking, where the risks of obviously going down are clearly elevated?
I don't like the idea of trying to buy the dip here unless you are just very short term and skilled in looking at technical things. I mean, for one, considering the size of the decline and the loss in leadership of the Mag 7, I just flabbergasted that the VIX is only 25 or 26. Right. I mean, that plus the policy uncertainty. I mean, you'd think even if the market were on its highs and we were getting some of these like trial balloons or trial bombs, quite frankly, from the administration, that the policy uncertainty alone would account for a VIX like in the mid 20s, but we're just not there. So I don't see the panic in the options market at all, but it's just that rotation in leadership and just like the large daily gaps between like value and growth. And that's characteristic of a turning point. And by the way, Dave, I mean, this is sort of into the weeds, but we know there's a massive gap in valuations between large cap growth, large cap value. And let's set small caps aside for the moment.
Okay.
That's existed for a while, but if you remember the last summer's very similarly sized correction, we got to a point where like the daily action between large and small, you'd have days where there wasn't just a big performance gap, but one would be positive and one would be negative. So that the 21-day correlation, and I'm getting a little sophisticated here, it actually flipped negative in July, and it flipped negative 2 times in December. The only time that's happened in history was back in 2000, 2001, when there was just a massive headlong rush, I should say, into large value and everything else, quite frankly, away from large growth. And then also, people forget we did have a little mini 2-year upcycle in value vis-a-vis growth beginning in late 2020, kind of around the time the first vaccine was announced, and it carried through really the bear market of 2022, and then large growth reassumed leadership and went to an even higher high. But my point is, you're getting these wacky daily differences across various indices, and the leadership in terms of large growth, and I'm pointing down because we look at a ratio of growth to value, but that is like the strongest conviction I have right now from looking at the charts. And then and people have been calling for that rotation for a while, but just another like sort of, I guess, stylized fact of leadership shifts historically is that they disproportionately occur during bear markets, and well, most especially recessionary bear markets, because it's sort of it's a reset, right? It's a reset in valuations. It's a reset in maybe like the leading sector of the economy. So that is where if you're heavily exposed to the S&P and maybe have a heavy dose of like QQQ on top of that, or a Russell 1000 growth fund, that sort of thing, it's not like you need to go short, but there are lots of hedging vehicles. I mean, to the extent that you have large taxable gains in those funds, you can go in and maybe just hedge away some, not all, but some of that downside risk. And hey, if I'm wrong and we go on and we trace out even a wilder bubble ascent over the next several months, well, you'll capture part of it, but you could protect yourself from a very nasty haircut if a mild cyclical bear market is accompanied by that violent leadership rotation.
No, that's really well said, Doug. And you've addressed, I think, a couple times here, just this rotational environment, and that I feel like in late 2024 was what we were sort of waiting for, right? Sort of a real
Yeah,
significant rotation. We never saw it. Now, all of a sudden, I think you're seeing that so much, right? With defensive sectors that have just been absolutely, I mean, consumer staples, which have been chronic underperformers, all of a sudden starting to bounce and test 200-day moving averages
yeah.
in a way they haven't done in many moons. So we've seen quite a bit of that. Can we talk a little bit about semiconductors in particular, because that was an area of the market that I feel like was sort of the one of the key moments of 2024. Certainly the first half, just semiconductors absolutely popping to the upside, the AI trade, etc. It sort of cooled off, and now I feel like when you take a step back and look at the semiconductor chart, we're looking at a 2-year chart of the stocks here. I mean, it topped out in July of last year, and it hasn't seen that new high since. What do you see when you're looking at this from a technical, maybe from a fundamental perspective as well? But talk about an area like this. I mean, for a lot of investors, I feel like this is probably a bit of a surprise to just acknowledge how semiconductors have not really been in an uptrend for a while now.
Well, first of all, full disclosure, we own past tense, the semiconductor equipment stocks for almost 8 years via our group work. And I constantly thought we were overstaying our welcome in the group and was wrong.
Right.
And they turned out to be, more growth and less cyclical than I would have anticipated. But finally, our group work, which is a mix of, there's certainly some relative strength in there, but there's capital allocations, there's earnings estimate revisions, there is valuation, there's a lot of stuff.
Yeah.
I mean, we finally exited that group late last fall. I mean, we didn't sell the top. Only liars try to do that, and only fools attempt that, and only liars do it, I think is the old saying. So we sold as they were beginning to underperform, but it's just that, again, I felt, because we held them so long and was like reading some of the massive spending and just wildly bullish AI forecasts, it was just interesting that we were finally exiting them as the AI cheerleaders were saying, oh, this is just the first inning. So I kind of like the fact we were selling into that hype. But you're dead right. It was, in hindsight, a tell that during a pretty manic phase for other high risk and AI levered groups, and even crypto as like another just super high expectations new world vehicle, that the semis couldn't participate with that. So if you look at, and it's kind of harder, I think, to see in this chart, but last summer they were tracing out like the classic head and shoulders.
Yeah.
Like the left shoulder was like way back in the spring, and the actual peak was in July. And then it looked like a classic right shoulder. Well, I don't know if you've ever had a separated shoulder, Dave, but I had a bike crash several years ago, and it was my right shoulder. So that right shoulder, I think it's too elongated, right? Like, to be a head and separated shoulder pattern.
I think the separated shoulder pattern was born right here on the podcast. That's awesome, Doug. Thanks for that. Okay.
But now let me just pull up the SOX index, okay?
Yeah.
Because I think, and anyone who doesn't believe, well, here we are. I mean, it's still resisting the early August. We have a ways to go yet. I mean, as bad as everything else in tech land is breaking down, this SOX is resisting. But if you don't believe, I mean, if other people believe in like the 43.90 price level on SOX, then it's real and it impacts behavior. And then again, we would go one further and say that, the wealth effect it's not just, I mean, it affects the real economy. By the way, there's a quote along those lines, Dave, that I've shared a couple times, just because a market juncture like this just brings it to mind. And it's a George Soros quote from like 15 years ago.
Okay.
So I'm like, oh, okay, there go like all of our right-wing fund clients, right? It's like I'm quoting George Soros, right? But hey, unbelievable speculator. So that's how I judge the
That's
guy.
fair. That's
Okay.
fair.
The quote is, I mean, it's just so elegant. He says, or said, it was 2011. I looked it up and made sure I got the exact verbiage right. He said, financial markets have a very safe way of predicting the future. They cause it. It's spectacular. But think about it.
Oh, it's
That's a
excellent.
distinct advantage the stock market has over even the most accurate economist who's ever lived.
Yeah.
Is
Yeah.
the stock market's verdict, the bloodless verdict of the marketplace, as it was called 100 years ago, has an impact. So it's not just, you're taught like in the CFA program, hey, it's a discounting mechanism that looks out 3 to 6 months. And that's right. But it is also a driver of near-term economic activity. And when it grows to be more than 2 times the size of the economy, it's even more so a driver.
Yeah. Yeah. No, well said. And that's a fantastic quote.
Isn't it great?
I'm gonna generously borrow that one from you. That was well said. So tell me this, like, I mean, given the conditions, given the fact that we've now seen this drop, given the fact that growth areas like semiconductors have been struggling, looking forward, a little bit forward here, where are you seeing opportunities, or how should we be thinking about positioning? Is it in defensive sectors, areas that are still starting to show some strength? Do you lean into alternatives, things like precious metals, which are holding up well?
Yeah.
Bonds have rallied, right? I mean, and
Yep.
inversely to stocks here. Where do you sort of think opportunistically, given the uncertainty in the equity space here?
Well, here's where we would diverge a little bit from like the standard, like macro strategist you would see on CNBC. And some of them I think are very good at this when they turn more cautious on the stock market. The knee-jerk response or recommendation is utilities, healthcare, staples, and they certainly worked, right?
Yeah.
The issue, Dave, if we tried to allocate to sectors or industries based on our near-term economic call,
Yeah.
we'd have equity turnover of 500 or 600% a year, or maybe more. So
Right.
our equity holdings, and it's not at that broad sector level, it's groups and themes. So when I mentioned semiconductors earlier, it was semiconductor capital equipment, not semiconductors broadly. So it gets pretty granular. But what I would say, Dave, and this is, again, it's a nuanced message, but when we decide it's time to have a lot less beta in our tactical strategies, rather than just like liquidate positions that are thematic in nature and that may have multi-year appeal above and beyond the business cycle, we will put on a hedge. So we're sort of unique in that perspective. And then the hedge is also homegrown. We have the Leuthold Grizzly Fund, but when we hedge in which is 100% short, quantitatively vulnerable stocks, we're not looking for like fraudulent or potentially fraudulent businesses like Jim Chanos would be doing, where they go to zero, a terminal short. He was very good at that, right?
Yep.
We're looking for, fading relative strength, expectations that are too high, high valuations, that sort of thing. So, and that's pretty high turnover. But anyway, that will have themes on the short side that develop time to time. What we have done more recently, which is a comparative a rarity for us, is we're short a little chunk of the QQQ.
All right. Okay.
With a leash on it. It's an emotional, highly charged asset, but we do think, now that you saw topping signs into the top and now you've had downside confirmation, that's got a lot of downside risk. So
yeah.
What I'm getting at here, Dave, is when I talk about what we own in long equities, they're not always in sync with like a recessionary outlook. And how we take care of that more is with the asset allocation than, selling what we have that's economically exposed. What's interesting, and I'll cut to the chase here on what we like on the long side, is we've moved in the last 12 months in our long only equity select industries from 8 or 9% in financials to roughly 30% today.
You're
We've
right. Okay.
investment banking, brokerage, the big regional banks, P&C insurance would be like the most defensive of the financial groups that we own, and also
Yeah.
an inflation beneficiary. I don't know if you've been paying attention to what might be happening with home and car insurance, like in the state of California. Okay, there's pricing power there.
Yeah.
But you could also argue, I mean, as maybe a secular support for financials. I mean, you do have an administration that is in favor of far looser regulations on these big companies. And it's a sector that is as well insulated, arguably, from tariffs, which we didn't even think about as we were putting on these positions earlier and before it looked likely that Trump would win.
Right.
But am I going to sit here and argue that, oh, financials are going to go up during a recession and everything is going to go down? No, I don't think it's going to unfold quite that way. Hence the equity hedges.
Right. Right. No, that's so interesting, Doug. And I appreciate you talking about it. I feel like for a lot of individual investors in particular, they think very binary. It's like I
Yeah,
own 100% of something or I own 0%. And they're
yeah,
desperate to kind of time this right. And what I think what you're describing is a much more kind of nuanced way of understanding risks versus rewards
right.
and thinking about when you want exposure to the market going higher and thinking about when you want to hedge that. And there are a lot of things like the Leuthold Grizzly Fund sounds like one of those ways to,
Yeah,
think about and sort of have opportunities in case there's deterioration, but not lose the long-term benefits
yeah,
of market appreciation. Doug, it's been such a fun conversation. I wish we
yeah,
could keep going for a long time, but you spoke of being in the market being emotionally charged. And I meant to
yeah.
ask you earlier, have you come down from the emotional high of Ohio State winning the national championship yet?
No way. I mean, I've
Right?
been walking on a cloud with my bad knees for almost 2 months, and look, I'm into like full disclosure, and maybe it's because we have like a paper record each month of
Yeah.
everything we write about the market. So
Yeah.
it's like I'm very humbled in my thoughts and opinions. But I'll say about a year ago at this time, Dave,
Yeah.
I hated the expansion of the playoff to 12 teams.
Yeah.
And then I don't know, along about like late November, I thought, I think we ought to like give this thing. Let's be open minded. Let's see what happens.
I love it. I'm a huge fan of the playoffs. I think
Yeah,
it's working, right? I mean,
yeah,
let's not mess with it.
yeah. And every time we expand the playoff, I mean, you remember the last title had been 2014. It
Yeah.
was They would not have been in the playoff if not for the expansion to 4. So
Yeah.
I'm a
Yeah.
huge fan. People say we're dinosaurs here looking at all this old data at Leuthold. It's like, no, we're being dragged kicking and screaming into 2025. So, no,
Oh, I love it.
I feel great about it. And
I
it is,
love it.
there's still a stain on it, though. You didn't beat your rival. I'll concede that, but it still
Could have
feels
been
pretty
more
good.
perfect, but I'll take it. I'm sure you will. You
Yeah.
will as well.
It
Doug,
ruined my
listen.
Christmas, but MLK Day was pretty special.
Well, it's good to see you, Doug, and thanks for the thoughtful comments about the market environment. Thanks for giving me a moment to relive the Ohio State championship. But going forward, listen, be well, stay safe there in Minnesota. We'll look forward to catching
Okay.
up again soon. All right.
Great to see you, Dave. Fun, a lot of fun. Take care.
It was a lot of fun. And again, if you're not a big Ohio State fan, I apologize for dropping that question at the end. But Doug is a fellow Buckeye, and I always enjoy chatting Ohio State with him. He's one of those guys when there's a big moment in Ohio State history, I usually write Doug so we can have a little banter about it because we're usually happy and sad right around the same times. I thought our conversation was a lot of fun. I mean, and it's such a pleasure to talk to someone like Doug who has some great experience as a money manager, as a market strategist, has worked with so many clients around the world through the Leuthold Group, and just really cool to get the perspective of someone like that, experiencing these same markets that we all are. I thought toward the end, his comments about, changing positions versus using hedging strategies was really thoughtful. I mean, that's really what he described as more how an institutional investor would think of navigating this kind of period, whereas individual investors all of a sudden get very short term. And even if you're not a swing trader, you feel like you need to do that just to make money. And I think, Doug's more thoughtful, more long-term perspective was using hedging to just sort of manage the risk that it is inherent in this sort of period of market uncertainty. Boy, if the separated shoulder pattern becomes a new thing, we can trace it all back to this episode. I love that comment. And what that is, the pattern we were describing was basically a basing pattern, a head and shoulders top where the right shoulders just keep going. I mean, it's sort of like a head and shoulder and shoulder and shoulder. Maybe it would be another way of describing it. But, again, just talking about that particular group, such a key bellwether group for so long, how it's challenged relative to other areas of the market, and where we're starting to see opportunities elsewhere here as we wrap Q1 of 2025, I thought was really interesting. So great conversation. Thanks again to Doug Ramsey of the Leuthold Group joining me from Minneapolis this week. That'll do it for today. By the way, as a reminder, if you want to learn more about some of the patterns and techniques and technical strategies that we discussed and debated on today's episode, our Market Misbehavior Premium membership could be a really good opportunity for you to improve your own understanding and hopefully upgrade your market awareness as we continue to navigate this period of market uncertainty. 3 great benefits to the Market Misbehavior Premium membership. Number 1, access to all of our virtual courses. Our main one is called the Flight School Behavioral Investing. We'll talk about behavioral finance, technical analysis, how they all fit together. We have a course focusing on all of our previous webcasts where we dig into a lot of different indicators and themes. And also we're actually in the final stages of releasing our latest course called Flight School Technical Indicators. We'll go through a bunch of different technical indicators, the buy and sell signals, how they're calculated, how they're derived, examples of how you can use them to improve your own returns and your own decision making. Second great benefit would be all of our members-only reports. Our weekly flight plan is our main report. We put that out every weekend. As the markets are closed, we take a step back and reflect on key patterns, levels, and indications to look for in the week to come. Also, our monthly chart review, where we apply our proprietary market trend model to a bunch of different asset classes and ETFs. Finally, of access immediately to our members-only community. It is a thriving, growing, and active community of like-minded investors navigating these markets, asking questions, and I'm in there every day answering questions from our premium members. We're starting to see different members respond to each other's questions, so it's a really great supportive group, and we're always looking for some more like-minded members to help navigating these markets using technical analysis. For more information, go to marketmisbehavior.com/premium, and don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. I'm Dave Keller, and remember, it's always a good time to own good charts.